Every trader dreams of finding that one perfect strategy, the magic chart pattern that will finally make them rich. And if you've been in the markets for even a few months, you already know there's no shortage of strategies out there. You can Google candlestick patterns, you can buy a course on moving averages, you can copy some trader's system on Twitter. But here's the funny thing. Even after knowing the setups, even after learning the technical side, most traders in the US, whether they're in Chicago, Dallas, Kansas City, or right here in the Midwest, still end up losing money. And the reason isn't the system. It's the psychology behind how they handle risk. Think about this for a second. You've had a long 9-to-5 shift. Maybe you work construction in Oklahoma City, or you're in an office job in St. Louis. If you finally sit down in front of your trading screen in the evening, you've got your plan, you know your entry, you know your stop loss. The chart starts moving, you take the trade. But the moment that first small red candle appears, something shifts. Your heart rate spikes, your palms get sweaty, your brain screams, get out before it's too late, and suddenly you close the trade early. You didn't follow the plan. Not because the system failed, but because your emotions took over. This is where psychology and risk management collide. See, our brains are not built for trading. Human nature is designed to avoid pain, to seek safety. That's why losses hurt almost twice as much as gains feel good. Psychologists call it loss aversion. So even if your system says, hold, the stop loss hasn't hit yet, your brain says, no way, I can't take the pain of losing more. And you exit early. On the flip side, when the trade goes in your favor, greed kicks in. You want to squeeze out every last dollar. You ignore your exit plan, you hold too long, and suddenly the market reverses. One moment you're up $200, the next you're break even or worse. That's not the strategy messing up, that's psychology tricking you into bad decisions. Let me put it another way. Imagine you're watching a football game in Texas. The quarterback throws 2 good passes, the crowd is excited, the coach is confident. Then suddenly under pressure he throws an interception. Did his skills disappear? No. But the pressure, the crowd, the scoreboard, they got into his head. Trading works the same way. It's not about whether you know how to throw the ball, it's about whether you can stay calm when the pressure builds. And here's the toughest part. Most traders don't even realize it's happening. They keep blaming the system. They jump from strategy to strategy, searching for the Holy Grail. But the real issue isn't the strategy. It's that their psychology isn't aligned with their risk management. They're playing the game with emotions in charge. So when we talk about risk in trading, it's not just about numbers on a screen. It's not just about a 1% stop loss or a 2% position size. Risk is emotional. Risk is how much pain your mind can handle before it makes you break your own rules. That's why, until you understand the psychology of risk, no strategy in the world will save you. Now that we've seen how psychology controls the way we look at risk, let's take it deeper and build a proper framework. Because here's the truth. Most traders in the US think risk management is just math. They'll say, oh, I set a stop loss, I calculate my risk to reward, I know my position size. But let me ask you, if it was only about math, why do so many people who know the numbers still blow up their accounts? The answer is simple. The numbers don't mean anything if your psychology can't handle them. Risk management tools are not just financial formulas, they are psychological safety nets. They exist to keep your emotions in check. Let's start with position sizing. Imagine you've got a $10,000 account. You put $2,000 into one trade. That's 20% of your capital. Now every tick against you feels like your heart is about to stop. Your brain goes into fight or flight. You're not analyzing the chart anymore. You're just praying it turns around. And most times it doesn't. Now flip it around. Instead of risking $2,000, you risk $100. That's just 1% of your account. Suddenly, you breathe easier. You can sit back, you can let the setup play out, because even if you lose, you've only lost an amount you can mentally handle. The math is the same, but the psychology is completely different. Let's bring in an analogy every American can relate to. Insurance. Nobody drives in the US without auto insurance. Why? Because an accident could cost you thousands, maybe tens of thousands. Without insurance, every time you drive down I-35 or Route 66, you'd be terrified of getting into a crash. But with insurance, you still don't want to crash, but you're not paralyzed by the fear either. You know if the worst happens, you're covered. In trading, your stop loss is that insurance policy. It doesn't guarantee profit, but it guarantees that one bad trade won't destroy you. It puts a cap on your emotional fear. And it's not just the stop loss. Another powerful layer is the concept of pre-commitment. This means before you even open your laptop in Chicago or Dallas or Oklahoma City, you've already written down your limits. I will only risk 1% of my account per trade. I will stop trading after I lose 3 trades in a row. I will close my platform if I hit my daily risk cap. When you pre-commit, you're making decisions with a calm brain. Because in the heat of the moment, when the candles are flying and your heart is racing, your emotional brain will always try to override logic. Having those rules written down and non-negotiable saves you from yourself. Here's the irony that surprises new traders. The ones who look the most confident, the ones who seem fearless, are usually the ones who are the most disciplined about risk. They aren't fearless because they don't feel emotions. They're fearless because their system keeps emotions in a cage. Just like a quarterback in the NFL doesn't run out on the field and make it up as he goes, he follows the playbook. A professional trader does the same. Their playbook is their risk management plan. And finally, think about the long game. Most retail traders focus only on the next trade. How much can I make today? How much can I make this week? But professionals think in decades. They know survival is the real edge, because if you blow up your account once, you're out of the game. Risk management is the bridge that keeps you in the game long enough to let your edge play out. So let's be clear. Risk management isn't about protecting your balance from a single bad trade. It's about creating a mental framework that protects your psychology, that calms your fear, that reins in your greed, that keeps you disciplined when the market is chaotic. The market will always test you, day after day. The question is, will you have the framework to stay calm when it does? All right, now that we've built the foundation, that risk management is really a psychological framework, let's move into the practical side. What can you actually do to control your emotions when you're in the middle of a trade? Because this is the part most traders miss. They hear about risk management, they nod their heads, but when the candles start moving, all that knowledge flies out the window. So let's talk about some practical psychological hacks that you can apply starting tomorrow. The first hack is pre-commitment rules. We touched on this earlier, but now let's go deeper. Pre-commitment is about writing down your rules before you start trading when your brain is calm. For example, write on a sticky note, I will risk no more than 1% of my account per trade. I will stop trading if I lose 2 trades in a row. I will never move my stop loss once the trade is active. By writing it down, you're removing the decision from your emotional brain later. Because in the heat of the moment, when greed or fear kicks in, you'll justify breaking your rules. The sticky note, the written contract, reminds you this was your plan when you were rational. Think of it like a coach drawing up plays before the game starts. Once the game begins, the team just follows the plan. The second hack is journaling your trades. This might sound boring, but it's one of the most powerful tools for rewiring your psychology. Here's why. Our brains are terrible historians. When you lose money, you remember it as worse than it was. When you make money, you remember yourself as smarter than you really were. That distortion keeps you from learning. But when you journal, writing down your entry, exit, reason for the trade, and how you felt, you create an objective record. Over time, you'll start to see patterns. Maybe you always break your rules after 10 p.m., or maybe you overtrade when you're tired after work. That awareness is gold because you can't fix what you don't see. The third hack is forced breaks. One of the most dangerous psychological traps in trading is revenge trading, trying to win back money you just lost. It's pure emotion. The best way to break that cycle is to give yourself a hard rule. After 2 losing trades in a row, step away from the screen. Go outside, take a walk, grab a coffee, reset. Think about it like football in Texas. If a quarterback throws 2 interceptions, the coach often benches him for a drive or 2. Not as punishment, but to let him reset his mindset. Traders need to do the same. A short break can save your account. The fourth hack is mind-body control. You might not realize it, but your physiology is tied to your psychology. When you're stressed, your breathing gets shallow, your muscles tighten, your body literally prepares for danger. That's why you panic close trades. Simple techniques like box breathing, inhale for 4 seconds, hold for 4, exhale for 4, hold for 4, can reset your nervous system in the middle of a trade. It sounds too simple, but it works because it sends a signal to your brain. You're safe. And when your body is calm, your mind can make rational decisions. Finally, the fifth hack is detachment from outcomes. This is the hardest one. Most traders tie their self-worth to whether a trade wins or loses. But here's the truth. One trade means nothing. It's just a data point in a long series. Professionals don't judge themselves by a single play. They judge themselves by the season. In the same way, you have to detach emotionally from each individual result. Your job is not to win every trade. Your job is to execute your plan flawlessly. The outcome will take care of itself over time. So here's the takeaway. Managing risk isn't just about numbers. It's about managing yourself. By pre-committing to rules, journaling your behavior, taking forced breaks, practicing breathing, and detaching from single outcomes, you build a toolkit that protects you from your own worst instincts. Remember, the market doesn't beat most traders. Their psychology does. These hacks are how you flip that around and take back control. By now, you've seen the full picture. Risk management isn't just about calculators, stop-loss levels, or percentages on a spreadsheet. It's about psychology, about how your mind reacts when money is on the line. Fear, greed, loss aversion, revenge trading, these are the silent enemies that wipe out more traders in the Midwest and across the US than any bad strategy ever could. Here's the mindset reset I want you to take away. Your goal in trading is not to win big today. Your goal is to stay alive tomorrow and the next day and the next year. Professionals don't obsess over the next candle. They focus on the next decade. They build systems that protect their capital, but more importantly, they build habits that protect their minds. Because in the end, surviving the market long enough to let your edge play out is the only real edge there is. So whether you're trading after your 9 to 5 in Oklahoma or sitting in Chicago, where futures trading has been a tradition for over a century, remember this: your strategy might get you in the game, but your psychology is what keeps you in it. Risk management is emotional management, and the trader who masters that is the trader who lasts. If this video gave you even one mental shift, don't just keep it to yourself. Share it with a fellow trader who might be struggling right now. And if you want more deep dives into trading psychology, mindset hacks, and the real lessons that Wall Street rarely talks about, hit that subscribe button and join this community. Because here, we don't just talk about making money. We talk about staying in the game. That's how traders turn from short-term dreamers into long-term survivors.